If you plan on becoming a day trader for 2021, really start keeping track of your expenses, everything associated with it. If you're taking education courses, seminars, trade shows, everything like that, just start really tracking your expenses.
Courtney Kurisko, welcome on the podcast. How's it going today?
Thank you. Very good. You?
I'm very good, very good. You in the US, I believe, right?
Yes, New York.
So today we'll talk about a topic that I get a lot of questions about, and I'm not the expert at talking about that, and I don't really like the topic myself. I hire people to do it for me, which is taxes and I guess accounting with that. But Courtney is going to be here today to talk about taxes, how it applies for traders, what things you can focus on, especially for the US. But I think a lot of these things we talk about today can apply to different countries. Maybe not the same exactly, but similar, right?
Right. Yeah, I mean, it's mostly going to focus on U.S. taxes and how to qualify as a trader under IRS guidelines. But generally, overall, yeah, we can talk, broader than that if you like.
Excellent. So for people who don't know you right now, could you tell people who you are and give a bit of background about yourself?
Okay, I'm Courtney Kurisko. I have CPA Accounting Tax Service in New York. I'm a CPA. I've been a CPA for about 16 years, and I've been focusing on day trader taxes for about 13 years. I work very closely with John Kurisko of Day Trading Radio, and that's how I became very specialized in my niche because he's been a trader since the 90s, and I'm married to him, so I had to learn day trader taxes to handle all his ins and outs of his business, and it became a very specialized niche, and my business has grown from there. I also do small local businesses, but really my niche is day trader taxes for many years.
I would like to maybe just kind of begin with a bigger picture of things. So, are taxes for traders similar to taxes for example, a self-employed person, or are there differences there?
Well, so there's a few different issues with taxes for traders. You can qualify as a business. The IRS guidelines, are very strict on how you qualify. But once you do qualify, then it's very similar to just having a sole proprietor business or running a corporation where you pay yourself a payroll or an admin fee, and you can deduct your general business expenses. But it's the biggest issue there is whether or not you qualify as a trader first.
Okay. And how do you define that? How would you know that if you're a good fit for that?
Yeah, so the IRS published a publication 550 where they outline a very broad qualification system for qualifying as a day trader, but court cases after that have sort of solidified what you really need to do to qualify. And I wrote some notes. So the biggest one is they say to trade substantially, regularly, frequently, and continuously. And those are very important. And the second one is to seek from profit from short-term price swings. And that is also very important to qualify. Substantially means that you really need to trade a considerable amount of time. You need to trade as a business, whether that be a sole proprietor or through an entity. And frequently, and some court cases have come out where it needs to be about 720 trades per year. So we average about 4 trades per day, 4 times a week. And that gives you about 75% of the trading days and a substantial amount. You intend to profit from a business, which means that you're there, you show up daily, it's a valid business. You don't leave from 9 to 5 to go do a W-2 job and then trade on your lunch break. That's really, one of the biggest questions I get. I have a 9 to 5 job, but I trade. Do I qualify? So, so in that sense, like I said, the IRS does not have a specific definition for a trader, but they have given guidelines as to what they expect to qualify as a day trader.
Okay, so it's not clear cut exactly, but it's kind of a sort of thing, and I can understand that. So people that have a full-time job wouldn't be able to be qualified as that.
Not necessarily, unless it's a high risk if you do have a full-time job. But if you have a full-time job where you're sort of manage your own time and you can dedicate 4 hours a day while doing a full-time job, but you have to be able to prove it. You know, you have to be able to prove it with the amount of the trades, with the value of your account. Usually we recommend over 25,000, and that you have to be in and out of the market with trying to do the short-term trades.
So that is classified as a day trader. Now, what happens if you don't qualify for that? What happens then?
Then you're an investor, and you just have to follow the investor tax guidelines. Also, I just want to mention, I get a lot of questions that, there's a lot of bots now and automated trading, that if you do use an automated trading system, that does not qualify you as a day trader.
Oh, okay. So then you have to follow the investor's rules in that case?
Yeah, investor
Okay,
rules.
interesting. So could you give us a breakdown of what changes between being a day trader and an investor then? What are the main differences there?
Yeah, so once you qualify as a day trader, you have two different options. One option is to just file your taxes as a day trader without the mark-to-market election. And in that sense, you get all the benefits of taking the deductions for the trader, margin interest, home office expense, telephone, things like that. Another option is to file as a trader business, but also take the mark-to-market election. And this is the Internal Revenue Code 475F that I'm sure a lot of traders are very familiar with, because what that election does is it reclassifies your trading income or losses as ordinary versus capital. And so what that means is if you have losses, you can take all of your losses as ordinary losses, which means they can offset other ordinary income, and they are not limited to the $3,000 per year loss limitations that capital losses are limited to. They also have a different, they have a different bracket. Well, short-term gains are tax similar, but you really want to, if you foresee, I know a lot of people in 2020 have some significant losses, so you really want to be able to utilize the mark-to-market election if you can, to be able to not be limited to the $3,000 per year. And the mark-to-market election also, you are not subject to the wash sale rules that without the election you're subject to. And a lot of swing traders I know, they're in and out of the market very quickly. So they are subject to the wash sale rules.
So it seems to me that in some manners being a day trader is more advantageous.
Yes, it definitely is more advantages. If you qualify, the mark-to-market election is very advantageous for tax purposes.
Okay, interesting. And are the taxes for either traders or investors, are they the same across the country, or do they vary between states?
Well, each state has its own tax, rate, but it's a federal election. It's not a state election.
Oh, okay.
The mark-to-market election.
What do you feel is the most confusing part for traders when they come to you and they want to do the taxes? What is it that is either the most tough to understand, or the basically people make most mistakes?
Okay, yeah, there's two things. One is whether or not they make the mark-to-market election, and the second one is what type of entity is best for them. A lot of traders, once we determine that they qualify, there are a few factors whether or not you want to make the mark-to-market election. And a few of those factors are, do you have prior year carryover losses? Because what happens is if you make the election with prior year carryover losses that are capital losses, and then you make the election, now your ordinary income and losses, your ordinary income is only offset by $3,000 in these losses. So those losses become locked in, and we really don't want to do that, save you a significant, $50,000, $60,000 losses from prior years. So making the election is very confusing to traders, whether or not that would benefit them. And the second thing is entity formation, because you really need to know what your long-term goals are for your entity, formation. Do you want to make retirement contributions? Do you pay your health insurance? Do you want to be on payroll? Will there be another person investing in your company? And those are all factors that, we have to take into consideration.
So is it possible for you to give an example of how a specific trader would be going through his taxes and kind of what structure he would decide to take?
Oh, okay. So let's say that you're a trader and in 2020 you want to make the mark-to-market election. If you make it as a sole proprietor, you have until July 15th, and you file the election with your tax return. And what that does is then you have your trades become ordinary, and they are no longer, we use a software to put together the trades. So it depends on the broker, I guess is what I'm trying to say. So then anyway, we put the trades together, and then the following tax year, you have to file a Form 3115 stating that you made a accounting change. And that's if you did it as a sole proprietor. And then your expenses would go on a Schedule C on your tax return. But then again, it's different. If you do a entity, then you would form an entity this year, and then that entity would file a separate tax return as long as it's not a single member LLC.
Do you have to define which structure you want to take at the beginning of the year, or can you decide throughout the year based on the result that year, and can that vary?
Typical tax years, you need to decide by April 15th. This year we got a bit of an extension to make that decision. You can form an entity anytime throughout the year. And again, there's a few different tax strategies that go along with that, because if you have, say you missed the deadline on April 15th to make the market election, and you have significant losses, you can form an entity throughout the year and make the election through the entity, and then we can discuss further what to do with those losses that you've had year to date.
And for you to be able to work with any trader, what kind of information do they have to give you to be able to do the taxes? I guess we talk about the broker. I'm sure they have to give you like their statement for the whole year, but what else would you need from them?
Well, it's a lot easier than it was back in the 90s when E-Trade used to mail boxes and boxes of trades. So we're definitely lucky now to have everything electronic version. I use TradeLog software. A lot of my clients, I usually recommend that they import all their trades into TradeLog software, and then I can go through the file and I can put the trades in order. And again, if they made the election, then I make sure they're not subject to wash sale rules, and then I export that information and attach it to the tax return.
Okay. And we talk a little bit about what happens if you are a swing trader and you take fewer trades, so if you are a day trader, you take more trades, or an investor. But are there any differences between the swing trader and the investor? They will both classify as investor for taxes, but are there any differences there, or is it pretty much the same?
I mean, a swing trader can qualify for trader tax status, or they can be considered an investor. And again, investors do not get to deduct the expenses that go along with the trading business, and they are subject to the capital loss rules of $3,000 per year. A swing trader can go either way. They can be a day trader if they qualify, or they can be considered an investor.
At this point, is the tax rate as a job, or would that vary in being a capital tax rate that people will have to pay in that case?
I mean, the tax rate for short-term, capital gains is equivalent to ordinary tax rate. So, I mean, really, it's you want to be able to maximize your deductions associated with the business. That's really where you benefit, and that's really where it benefits to qualify as a trader, because then you unlock a ton of deductions that can really benefit you. Things such as health insurance, retirement contributions. You can form an S corp and put yourself on payroll, and that really unlocks a lot of deductions. So that's really the main goal with traders.
Are there any topics that we didn't really talk about that you would like to include in this interview?
Really, I'm open to questions about it. And again, it's a little bit confusing because, like I said, you can qualify as a trader without making a mark-to-market election, and you can file as a day trader and have your income and losses as capital, and then still be able to benefit from all the deductions associated with being a day trader as a business. Or you can qualify for trader's tax status and make the mark-to-market election, and then that changes your type of income and losses to ordinary rather than capital. And I think that's really the biggest thing that I want to communicate to traders, and also how to qualify. That's also very confusing. So the IRS, really doesn't give specific guidelines. They give general guidelines, but we really look at the court cases and follow those to see who qualifies. And another thing is for 2020, I know a lot of traders had losses this year. And so one thing that is important to know is that if you did not have prior year losses and you had losses in 2020, that you really need to think about whether or not you want to make the mark-to-market election and possibly carry back those losses to prior years. And also, you want to take into consideration, what you trade. If you trade futures versus securities, you would make the mark-to-market election for securities and not necessarily futures. But again, everybody has an individual case. And then I guess I have to give a disclaimer that this is all just general information that you really need to consult with a tax advisor. You could definitely have a consult with me or another tax advisor.
What will happen? Let's say it's your first time as a trader to do it by yourself and you want to file your taxes all by your own to not by anyone. And then you decide that you qualify for trader taxes, but then you don't really qualify for that in real life. What will happen then? What will be the consequences of doing that?
I mean, that's really one of the biggest mistakes that I see with traders is that they, try to file their own taxes and make the election. And then what happens is 3 years later, I get a phone call from them that says, the IRS never received my election. I've been filing as a day trader, and now they're saying that I don't qualify. That's a huge mistake I see. Another huge mistake I see is that they make the election for trader tax status and mark-to-market, but then they don't file their tax return correctly. There are a few things that you need to put on your tax return that not only that lets the IRS know that you made that election and that you qualify. And that's the other thing. I have to go back and amend, multiple years worth of returns. If you were a trader and you didn't want to pay somebody and you want to file a tax return, I don't really recommend that.
Mm-hmm. No, definitely not. And that's kind of what I want to get to is that it's something you don't want to take lightly. You have to take it seriously. And the fact that personally, I've never done it myself because I think it's a lot of work that I don't want to get into much, and I don't like this topic that much. So that's why we have people like you that do this work, and people can have better results with that, and they can have less stress for sure.
Yeah, I mean, I get phone calls all the time, or somebody will call me, talk to me, get some information, and then try to do it on their own, and I always hear from them a year or two later. So, yeah, I mean, it's just the IRS is very strict. They don't want to give away this mark-to-market election because eventually, at one point, sadly to say, that some traders will have losses, and the mark-to-market election really lets you benefit from those losses. So the IRS really doesn't want to give that away. They would, so yeah, it's a little tricky. A lot of traders have gone to court over this very thing. But again, you really want to make sure that, you're trading substantially, regularly, frequently, really profiting, trying to profit from the short-term swings in the market. And I would always advise that if you have long-term investments and you're a trader, put them in a separate account. Or keep them out of the business name,
What will happen with someone that has both that does both short and long term investing? Would they have to kind of classify the two things apart, like break it down and do a different tax for each part, or would they do everything together?
Yeah, like I said, I wouldn't have them in the same interactive broker or account. I would have your long term in a separate account. I mean, the IRS can't say, well, you're a day trader, so you don't. I mean, think of any business owner. You have other investments. You don't just have usually one business. You can have other investments, and the IRS recognizes that. So usually I recommend that if you're going to take a position and hold it long term, meaning more than a year, that you really need to keep it in a separate account.
And what about let's say someone that began to trade this year and they took 10 trades or something for the whole year, and they made a very small profit? Would they still report the whole thing, or is there a process that's easier for them to do when it's their first tax as a trader?
I mean, in that case, I would just file as an investor this year, and then if you plan on, becoming a day trader for 2021, really start keeping track of your expenses, everything associated with it. If you're taking education courses, seminars, trade shows, everything like that, just start really tracking your expenses. And then at the beginning of the year before April, contact a tax professional, contact me, and have a discussion. I traded in 2020 as an investor. I just started trading, but now I'm really taking it seriously. What do I do as a trader?
We mentioned the fact that you could apply some of your expenses to your taxes for a trader. What are some things that you cannot apply in your expenses?
I mean, some traders try to take things like travel. You have to consider that traders probably aren't really traveling. Meals and expenses. Again, you're not a trader. You're not trying to, unless you're trying to go get another investor for your company, to to add funds or equity into your company. So those are things that I don't really see beneficial to a trader. Those are a little bit of a red flag. You do get to take your margin interest and any subscriptions you have to news feeds, data feeds, chat rooms. You could take a portion of your utilities, home office, things like that.
If you were to buy some equipment like a computer and everything, you could also do that. I guess that's with depreciation in that case.
Yeah, absolutely. And usually what I recommend, obviously, if you buy a computer that's dedicated solely to your trading business, then you can write it off 100%. A lot of times, again, I see traders buy a computer for their house that they trade 75% of the time on, and the other 25% is personal use. So usually we would just recommend deducting the 75%.
Okay, interesting. I think that makes sense to me. I think it's a topic that I'll never like focus on myself, but I'm glad you are able to kind of answer people's questions. And I suggest people that are watching this or listening to this that they put their question in the comment section, and then we might do like a future episode, or you might be able to answer these questions on a one-on-one if they call you or something. And I think that might be the best way to do things.
Absolutely. I'd be happy to do that.
Excellent. So thank you very much, Courtney. I appreciate your time. I appreciate the advice you gave today for this topic on taxes, and I hope to talk to you soon.